Um, I think the market looks quite like it did in 1998. Okay, so we'll talk about the stock market. The stock market is many different types of companies, and now it's very much a function of the pricing of particularly certain types of tech stocks. Those companies have now gotten a lot more expensive. I think it depends on what stocks. Yes, the leading stocks, the market as a whole, they're expensive. I think that, for example, the superscalers, the Magnificent Seven and so on, have become expensive, and that there's opportunities in the next in AI will come in applications and the using it and who will use it to change their course and have big impact. I think it's very much like the internet and the dot-com period. It's very much like that. So yes, it's relatively expensive. And yes, if you have an interest rate rise when it's relatively expensive, it's not likely to be good. And so that is where it is in terms of these great companies. And I think rotation is the important consideration. And what concerns me is so much of your focus and so much of the focus on stocks and those things, and rather than building a well-diversified portfolio. I'd say my concern about bonds is clear. I think the market looks quite like it did in 1998. Okay, so we'll talk about the stock market. The stock market is many different types of companies, and now it's very much a function of the pricing of particularly certain types of tech stocks. The segmentation, yes. The segmentation of the market. Those companies have now gotten a lot more expensive. And like 1998, they're wonderful companies. They're going to have a fantastic futures in various ways. We don't know who the winners will be, but their prices have gotten expensive. One of the important things to distinguish for any investor is distinguishing a good company or a great company from a price, the great price. You can buy a bad company at a great price and you'll make money. And you can't buy a great company at a bad price and make money. So the price matters. So now you have a situation, here we are, very similar, that the prices of those that have been leading this market are relatively expensive, and you could have an interest rate increase. We've seen this scenario before, right? I don't want to take responsibility for telling, I'm not meant to be an investment advisor, and particularly things can change. I will say that the important thing, if you're building a portfolio, is to know how to have excellent diversification, to not be systematically leverage long. Most of the world is leverage long right now, but to pay attention to this issue with how the debt goes, because it'll matter. And then I think also alternative money. What is the alternative money? Gold? Is it going to be Bitcoin? Is it going to be okay? But to think about how to have diversification. My mantra in investing, if you follow this mantra, if you achieve this mantra, you will make a fortune. It's your holy grail. It's my holy grail. 10 to 15 good uncorrelated return streams that are risk balanced. The power of diversification. Everybody's thinking about what is the best bet, and they don't realize that with diversification that way, the first three diversified, relatively uncorrelated assets will reduce the risk almost in half. So that means you double your return to risk ratio. The game is played on not getting out. You know, the nature of losses, here's the nature of loss. You lose 50%, you have to make 100% to get back. So it's a risk return game. And so if you know how to put that diversification, and it's very sensitive to interest rate changes. So those are the things I'd like to emphasize. Yes, I'm worried that if we don't get close to that 3% number, we're going to have a supply demand problem. And I think it could be significantly higher than the 3%. I mean, 5%. Look at the market action. It's indicative. Market action, long-term rates going up while short-term rates are touted to go down, easing of monetary policy. It's a supply and demand issue. And so then the question is, if there is a supply demand issue, does the Fed and other central banks around the world, we're seeing this happen in the UK, we're seeing it happen in France, we're seeing it happen in different places, that market action I'm talking about. In other words, when rates rise, led by long rates, when the central bank is inclined to ease, and then you see currencies go down, particularly, let's say, in relation to gold or your relation to other, and the Bitcoin and so on. It's a supply-demand issue. I think we need to think about what is the alternative currency, because all currencies have this issue. Debt is currency, and currency is debt. So what I mean by that is, when you're holding debt, you're holding promises to receive currency. And what that currency is worth depends on the supply and whether they print it and so on. When you're holding currency, you're holding it in the form of debt. So we have a situation where we have too much debt. We have too much of it, and we're producing it at a fast pace. So we have to think, looking at history, what is the alternative money? And money has two purposes. It's a medium of exchange and it's a storehold of wealth. So yes, we have to think about alternative monies. And by the way, this is not individuals who are just thinking about it. These are countries and central bankers who are thinking about it. The changing in the holdings of bonds and debt as an asset, and the buying of gold and other assets in terms of the mix, is a reality. I think it's all the supply demand. What raises the supply? If the long rate is rising, and then you have this selling of bonds and so on, the federal banks, because all of them it's true for, they will have a choice. And if you get it, I mean, combined with the pricing of assets, then PE multiples go up, expected growth rates of earnings and economic activity goes down. And you know what those cycles are like. Or the most important thing is realizing that competing in the market, there's alpha and there's beta. What I mean by alpha, I mean are you beating the players? Mm-hmm. Competing in the markets to produce alpha is more difficult than competing in the Olympics. You wouldn't think to yourself, I'm going to go compete in the Olympics. But there's more people chasing after it, and it's a zero-sum game. Alpha is a zero-sum game. To get alpha, you have to take it away from somebody else, right? Beta means there's an asset class. Okay, so first, be humble. Second, diversify well, because you don't pay a cost for the diversification, but you have to know how to risk balance your investments to diversify well. This is key. Be humble, or like in any game that you're competing. Also, get away from the notion that investments which have done well recently are better investments rather than more expensive. You have to know the difference between an investment that is, it's gone up a lot and it's done well. This is another problem. It's supply demand. Who's overweighted and why? You know, these memes, when it ever becomes, everybody believes it.
It's time to head for the gates, right?
Yeah, right. And that, so be humble, be diversified. Don't assume that because it felt good recently and gave you good returns, it's a better investment. These are the basic fundamentals.